Is the world on the brink of another financial meltdown? And is the one thing everyone trusts as a safe haven secretly the trigger? We're not talking about stocks, not crypto, but gold, the shiny metal that has been mankind's ultimate store of value for millennia. Central banks are buying it up at a record pace. Billionaires are quietly hoarding it. And now, some of the biggest names on Wall Street are making a shocking prediction. Gold is about to hit an eye-watering $4,300 an ounce. But here's the terrifying question nobody is asking. What if this is on a sign of safety, but the final warning siren before the entire global economy implodes? What if this gold rush isn't a boom, but a bubble so massive it could make 2008 look like a minor hiccup? Stick with me, because what I'm about to reveal will change the way you look at your money, your savings, and the very stability of the world we live in. This isn't just about an asset price. It's about a potential economic reset that could affect every single one of us. Let's start with the hard numbers. For months, gold has been on a tear, smashing through previous records. While you were watching the stock market, gold quietly climbed past $2,000, then $2,100, and is now flirting with all-time highs. It's been one of the best performing assets, and most people haven't even noticed. So where is this $4,300 prediction coming from? It's not from some obscure analyst in a basement. We're talking about heavy hitters like Bank of America. They've crunched the numbers, looked at the global economic landscape, and come to a stunning conclusion. Their logic is actually quite simple and terrifyingly plausible. They see a perfect storm brewing. First, let's talk about the Federal Reserve. For the past 2 years, they've been on a mission to fight inflation by hiking interest rates at the fastest pace in decades. But now the narrative is shifting. The consensus is that the Fed is done hiking, and the next move will be to cut rates. When interest rates go down, holding cash or bonds becomes less attractive. The yield, the return you get, shrinks. So where does big money flow? To assets that don't pay a dividend but hold their value, and gold is the king of that category. As soon as the Fed signals the first rate cut, analysts predict a flood of institutional money will pour into gold, pushing prices skyward. Bank of America's model suggests that for every 1% drop in interest rates, gold prices could surge significantly. And with predictions of multiple rate cuts over the next year or two, you can see how the math starts to add up to some crazy numbers. But it's not just the Fed. The second, and perhaps more powerful, driver is who is buying gold right now. It's not just your average investor. It's central banks. China, Poland, Singapore, Turkey. Their central banks are buying gold by the metric ton. In fact, they've been buying at the fastest rate in over 50 years. Why? This is the critical part. They are diversifying away from the US dollar. For decades, the dollar has been the world's reserve currency. But with rising geopolitical tensions and America's ballooning national debt, countries are getting nervous. They don't want all their eggs in one basket, especially if that basket is held by a geopolitical rival. So they're trading their dollars for the one asset that has no counterparty risk, no government that can print more of it, physical gold. This isn't a short-term trade. It's a long-term strategic shift in the global financial order. When the biggest financial institutions in the world, central banks, are all making the same move, it creates a massive, sustained demand that can drive prices to levels we've never seen before. Add to this the fact that U.S. debt is now over $34 trillion and climbing. Every time the government prints more money to pay its bills, it devalues the existing dollars in your pocket and in the world's reserves. Gold, with its finite supply, becomes the ultimate hedge against this currency debasement. So you have a trifecta of bullish forces: impending rate cuts, massive central bank buying, and a hedge against a devaluing dollar. From this perspective, $4,300 doesn't just seem possible. Some would argue it seems probable. Okay, so that's the bull case. It's compelling, it's logical, and it's why so many people are getting excited. But now, let's flip the coin and look at the dark side. What if this isn't a rally? What if it's a bubble? And what happens when it pops? The argument for a bubble rests on one key idea: panic. The price of gold isn't being driven by its industrial use or its utility. It's being driven by fear. Fear of inflation, fear of recession, fear of geopolitical conflict, fear of a US dollar collapse. Gold is a fear gauge, and right now that gauge is redlining. Think about it. When everyone rushes for the same emergency exit at the same time, it creates a stampede. In financial markets, this stampede is called a speculative bubble. Prices detach from their fundamental value and are pushed up by pure momentum and the fear of missing out. People buy gold not because they've analyzed its intrinsic worth, but because they see the price going up and they're afraid of being left behind. Sound familiar? This is the same psychology that fueled the dot-com bubble and the 2008 housing crisis. Here's why a gold bubble could be so much more dangerous. Unlike stocks or real estate, gold is seen as the ultimate safe haven. It's the bedrock of the financial system. If that bedrock cracks, the entire house comes down. Imagine a scenario where gold does hit $4,300 an ounce. At that point, it will have sucked in a massive amount of capital from all other asset classes. Pension funds, retail investors, everyone will be piling in. The market will be euphoric. But what happens when the fear subsides? What if inflation comes down faster than expected? What if geopolitical tensions ease? What if the Fed pivots and decides not to cut rates as aggressively? The same forces that propelled gold up could reverse with brutal speed. If central banks, who are now the biggest buyers, suddenly turn into sellers to lock in profits, who is there to buy from them? If institutional money sees a better return in bonds or stocks, they will dump gold in a heartbeat. The rush for the exit would be catastrophic. The price would plummet, and everyone who bought at the top, convinced they were buying safety, would be wiped out. This is the crash scenario. A rapid, violent collapse in the price of gold would send a shockwave through the entire financial system. It would trigger a reverse wealth effect. People who felt rich because of their gold holdings would suddenly feel poor and would slash their spending. Companies and funds with heavy exposure to gold would face margin calls and potential bankruptcy, leading to forced selling of other assets like stocks and bonds to cover their losses. This contagion could spread, creating a domino effect that could trigger a global recession, or worse, a depression. The very asset that was supposed to protect us from a crash could become the catalyst for the biggest crash of our lifetime. The irony is staggering. The worldwide stampede for safety could be the very thing that destroys it. So where does that leave us? We're standing on a knife's edge. On one side, you have a powerful, logical case for gold continuing its historic run, driven by fundamental shifts in the global economy. On the other, you have the terrifying specter of a speculative bubble fueled by fear that could pop and unleash economic chaos. The $4,300 price target isn't just a number, it's a symbol of this crossroads. It represents a future of either incredible wealth for those who are correctly positioned, or devastating losses for those caught on the wrong side of the trade. What should you, the individual, do? This is not financial advice, but a framework for thinking. First, understand the game that's being played. The surge in gold is not a random market fluctuation. It's a reflection of deep-seated buran, a Korean word for anxiety and insecurity in the global financial system. The big players, the central banks and institutions, are making strategic moves to protect themselves. Second, avoid making emotional decisions. The fear of missing out, or FOMO, is a portfolio killer. Don't rush to buy gold at its all-time high just because you hear a big price target. Conversely, don't dismiss it entirely. A prudent approach might be to consider gold not as a speculative bet to get rich quick, but as what it has always been, portfolio insurance. A small allocation, perhaps 5 to 10% of your portfolio, can act as a stabilizer. If the doomsday crash scenario happens, your gold holdings will likely appreciate, offsetting some of the losses in your other assets. If the bubble pops, your exposure is limited, and you won't be wiped out. The key is balance and diversification. Don't bet the farm on any single asset, whether it's tech stocks, crypto, or gold. The world is simply too uncertain. The story of gold in the coming months will be about more than just a price chart. It will be a story about trust, fear, and the shifting plates of global power. Whether gold hits $4,300 and becomes the savior of portfolios, or whether it becomes the epicenter of the next great financial crisis, remains to be seen. But one thing is certain, ignoring it is no longer an option. The stakes are simply too high. What's your take? Are we on the verge of a golden age or a golden collapse? Let me know in the comments below. Thanks so much for watching. If you found this breakdown valuable, please hit that like button and subscribe for more deep dives into the economic forces shaping our world. Stay informed, stay critical, and stay safe. See you in the next video.